Hello there and welcome to the VIP Financial Education YouTube channel where we help you go further, faster financially. I'm your host, Michael Matthey. Thanks for tuning in today, guys. We've got what we feel is a very important and interesting episode for you. We're going to be talking about President Biden's tax plan. Now, this is a plan that he has touted on the campaign trail, and now it is actually going in for legislation into the House and then ultimately the Senate. So there's a lot of moving parts here. What we've done on your behalf and what we're always going to try and do is get as much research as we can. In some cases, we're going to form some of our own opinions on it, but ultimately what we're going to do is read the tea leaves on your behalf so that you guys can do some additional research, obviously, that will benefit you, and we're going to be an advocate for you in every one of these episodes. This one is going to be a little bit different, I think, in that I'm not going to give my opinion on this. I'm going to give a very objective approach, which I think anytime we're talking about, things that are politically motivated one way or the other, depending on which side of the aisle you're on, I'm going to take a very neutral and, again, an objective approach. So hopefully you can appreciate that. President Biden's campaign promoted a $5.4 trillion spending plan over the next decade and a framework to generate $3.4 trillion in new tax revenue. It remains at this point to see how successful this plan could be, or if it's even going to make it through. But with a completely Democrat-controlled Congress at this point, there's no better time for them. Simply put, the majority can really push their agenda right now. Now let's go ahead and dive into some of the data points here, and you're going to have to make your own informed decisions, guys. There's a lot of important data here that can lead to how you're going to react, how the market is going to react, and really, frankly, what to do with your long and your short-term investments. This article is per Reuters. U.S. stocks dived on reports President Biden planned to almost double the capital gains tax. News analysts said provided an excuse to take profits in a directionless market ahead of big tech's earnings next week. The three main indexes on Wall Street also fell on reports that Biden planned to raise income taxes on the wealthy, a proposal some said would be hard to pass in Congress. Per Thomas Hayes, who's the chairman and managing member of hedge fund Great Hill Capital LLC, if it had a chance of passing, we'd be down 2,000 points. So obviously Hayes does not think that it's going to ultimately pass through the Congress. Paul Nolte, a portfolio manager at Kingsview Investment Management in Chicago, said that when a proposal like this is floated about raising taxes or capital gains, everybody gets excited, sells first, and asks questions later. This did cause a knee-jerk reaction in the Dow, which dropped about 300 points overnight, and it also caused a nosedive with some other asset classes, like we've talked about with cryptocurrency, in particular Bitcoin, which fell below $50,000 with this news. Now let's take a look where this proposed tax money would be coming from. Biden has proposed raising the corporate tax rate from 21 to 28% after the Republican tax cuts had slashed it from 35 down to 21%. Also part of that proposal is raising taxes on households that make over $400,000. And that's kind of that key benchmark that everyone hears about. If you're above that, you can already plan on really being affected. If you're below that, a lot of people are saying, well, this tax plan is ultimately not going to affect me anyways. And part of the data and some of the information I'm going to share with you is going to tell you that that's not absolutely the case. He also proposed changing capital gains tax, meaning how taxes are applied when someone sells an asset like a stock, for example. And that's going to be on people making over $1 million. There's also going to be an increase in capital gains from 23.9% to 39.6%, which according to Bloomberg, if that is passed, there will be $178 billion in sell-offs ahead of capital gains increases, which would most likely happen in early 2022. To give you some context, the average capital gains tax in Europe was 19%. This would be the highest tax rate proposal since the 1920s. About 40% of the revenues would come from tax increases with the highest earning households, and about 60% would be coming from higher taxes on businesses and specifically corporations. He would expand tax credits for lower and middle income families and also for new investments in domestic manufacturing. Under his plan, the Tax Policy Center, that the tax burden for the highest income would clearly go up, while tax burdens would fall for the bottom two sectors. Now, there may be a couple of fallouts that come from this and aren't necessarily a great thing from Biden's proposal. Many wealthy people may simply hold their stock until the next administration, resulting in a net tax loss, not a gain. Number two, they may move their money overseas. Many people making over $1 million will rarely sell sell. However, this will hit them very hard on their qualified dividends. And many Wall Street analysts are growing increasingly concerned that this Biden's proposal will put an end to the flourishing stock market as we've seen it in recent history. The benchmark S&P has rallied 10% as of last week, according to the Dow Jones market data. And the index itself has soared 85% since last March 2020's record low. According to Greg Valliere, who is the chief U.S. strategist at Toronto-based AFG Investments, this market is priced for perfection. At the very least, we're looking at a headline risk for Wall Street. And Biden, as part of his $1 trillion American Families Plan, is preparing a capital gains tax hike to 39.6 for the wealthiest of individuals. And that tax would increase to 43.4% when including a tax on net investment income. Wealthy individuals in blue states like California would see their effective tax rates at astronomical levels, meaning the mass exodus from states like those to states like Texas, for example, or Tennessee or Florida may ramp up even more than they already are. Last year, people were leaving those highly regulated blue states for less regulated red states due to the pandemic. And this year, that mass exodus may include people that are just simply trying to avoid those additional tax burdens. However, according to analysts at Goldman Sachs led by Alec Phillips, they would expect a more modest increase to around 28% that would likely not apply to gains realized before May and go into effect January 1st, 2022. Now, another common response that I've heard out there is I really don't care because I don't make above $400,000, so this new tax proposal is not going to affect me anyways. However, that statement really doesn't hold water according to many of the top economists because this will trickle down to lower income earners. According to the Tax Foundation, an increase in corporate income tax would reduce long-run economic output by 0.8%, eliminate 159,000 jobs, and reduce wages by 0.7%. Workers across the bottom income scale would bear much of the tax increase. The bottom 20% of earners would see an average of 1.45% drop in after-tax income in the long run. So as you can see, even though the increase is designated for corporations in that top 1%, there could be ramifications across all income levels. Now, what options do business owners have to protect themselves from this? And I'm going to give you a few here. Number one would be, of course, moving out of states with the highest proposed taxes. Number two would be to reduce your taxable profits. Number three would be to restructure your income. And number four, which would be an extreme one, but there's businesses that are doing it now, would be to move offshore. If you can afford it and your business obviously does not have a necessity to be within the United States, moving offshore is something that you could take a look at as well. Now, what can individuals and investors do to protect themselves? And I'm going to give you 4 solutions to this. You can certainly restructure and defer income to later years and collect capital gains during times of lower income. Number 2, you can utilize real estate where the consistency of appreciation versus rental income collected can often make that a great long-term investment in this scenario. Number 3, long-term investments are going to get off a little bit easier. Those short-term investments are what's really going to get hit hard. And number 4 would be take out loans against your investment. Paying that interest rate is going to be much lower than you would be affected by paying that capital gains increase. At the end of the day, there's such an unbelievable amount of spending going on right now that even with these tax increases, it's really barely going to make a dent in our $27 trillion debt as it stands today. As always, guys, we spend a lot of time and energy putting these videos together, and we really enjoy that. But do your own research based on your own financial and your own personal situation. Of course, we don't know who that is based on who's watching, but hopefully you can take some of these nuggets and this information that we've really condensed down for you, and you can go out there and make your own informed decisions based on that. If you like the content that you've seen today on this video and you want to see more like it, please smash that like button below. If you're not a subscriber already, we would love to have you as a subscriber on our channel. And as always, hit that notification bell if you want to see more content like this. Until next time, take care and make it a great day.